Imagine borrowing over $2 billion to buy your own stock. Right at the exact moment, your core, supposedly recession-proof business suddenly drops 11%.
Yeah, it's a massive red flag.
Right. So today we are opening up a highly restricted, incredibly detailed buy-side investment memo on Zoetis Inc., ticker symbol ZTS.
And if you own a dog or a cat or, if you follow the healthcare sector at all, you already know them.
Oh, for sure. They are the undisputed heavyweight champion of the animal health world. I mean, the absolute largest player in the game.
They are, but our mission today is not to just marvel at their historical dominance.
Exactly. Our mission is to answer one core, really high-stakes question for your portfolio. Is Zoetis still a viable, long-term compounder for your capital today? Or is the market just blindly pricing this stock based on a legacy of past glory that is, well, quietly but undeniably slipping away?
And we really need to establish the ground rules for this analysis right up front. We are looking at this through a professional, clear, and highly skeptical buy-side framework.
Yeah, so no cheerleading today.
Absolutely no cheerleading. It is vital to understand that there is a massive difference between a great company and a great investment at a premium price.
Right, because a company can make wonderful products.
Yeah.
Right, they can employ brilliant scientists, save animals' lives.
While simultaneously being a terrible place to put your money.
Because evaluation demands absolute perfection.
Exactly. So our job is to separate the polished corporate marketing narrative from the grinding mathematical core business reality.
I love that. So the lens we want you to look through as we pull apart this memo is this. What specific conditions would have to be true for the Zoetis investment thesis to actually work right now?
Right. And does the tangible present-day evidence actually support those conditions?
To figure that out, we really have to look at the collision between what the market thinks Zoetis is and what their internal numbers show they actually are today.
Yeah.
And, I mean, the sheer scale of this company is just staggering.
It's massive.
We are talking about a business that in 2025 generated $9.467 billion in revenue.
And that scale is really the foundation of the bullish argument. To break that nearly $9.5 billion down, about 70% of that revenue came from companion animals. So dogs, cats, horses.
And the remaining 30% came from livestock.
Yeah, which means cattle, swine, poultry, and fish. And geographically, they are heavily anchored in the United States, which drives about 55% of their total revenue.
Okay, but the detail in the memo that should immediately grab any investor's attention is their product concentration.
Oh, the top 10 list.
Yes. Their top 10 product lines make up 57% of their total revenue. I look at a 57% concentration in just 10 product lines, and I see vulnerability.
It's highly concentrated.
I mean, if even one of those flagship products stumbles, the entire ship basically lists to one side.
Well, yeah, but that is the structural reality of pharmaceutical development, right? Whether it's human or animal, you rely on blockbusters.
Yeah.
But what the memo points out is that this massive scale is currently masking some very deep cracks showing in the foundation.
Cracks like what?
Well, Zoetis is sailing into what can really only be described as a perfect storm of compounding headwinds. Historically, the analysts who love this stock have treated these issues as temporary or, secondary.
But not anymore.
No, right now they are front and center and they're hitting all at once. We are looking at highly price-sensitive pet owners, a noticeable deceleration in veterinary clinic traffic.
Which makes sense with the economy.
Exactly. Plus, massive generic erosion hitting their older legacy products, specifically the antibiotic Convenia and the anti-nausea drug Cerenia.
Oh, wow.
And on top of that, fierce, highly targeted competition in their biggest profit centers. Things like dermatology and parasiticides like Simparica Trio.
But wait, let me jump in here. Because if these are healthcare products, I mean, if a dog needs an antibiotic or needs heartworm medication like Simparica Trio, why is Zoetis seeing consumer discretionary style headwinds?
It's a great question.
Because it sounds like a luxury car brand that suddenly realizes its customers are checking the price of premium gas. If I need a prescription, I buy the prescription. I don't treat it like a new television or a vacation. Why is animal health care behaving like a luxury good?
Because the concept of necessity in veterinary medicine exists on a very, very wide spectrum, and the economics of the veterinary clinic have changed drastically.
How so?
Well, in emergency surgery after a dog eats something toxic, that is a strict necessity.
Right. You just pay whatever it costs.
Exactly. But a premium, branded, preventative, chewable medication. When household budgets are tightening because of inflation, and when the vet clinics themselves are, jacking up their exam fees to cover their own rising labor and overhead costs.
The chewable suddenly looks optional.
Or at least negotiable. That premium chewable suddenly looks like a line item where a consumer might try to save a little money. They might stretch a prescription from 30 days to 45 days.
Oh, I've definitely heard of people doing that.
Right. Or they might ask the vet for a cheaper generic alternative. Or, and this is the worst case scenario for Zoetis, they might defer the annual wellness visit entirely.
So the squeeze is happening at the consumer wallet level,
Hmm?
but it's manifesting directly on Zoetis' top line.
Exactly.
And if the top line is getting squeezed, that explains why the company might try to manage the optics of that pressure.
Which brings us to the first quarter of 2026 in the memo.
Yeah, this is a fascinating section.
On the surface, if you just read the press release, the headline, organic growth numbers, look totally acceptable. But the memo flags a major comparability issue. Zoetis changed its accounting presentation due to what they called a fiscal year alignment.
Right. So historically, Zoetis had a one-month reporting lag for its international subsidiaries.
Which is pretty normal, right?
Yeah, it's a fairly common legacy structure for massive multinationals. Basically gives them time to consolidate really complex global books. But in Q1 2026, they eliminated that lag to align the international calendar with the U.S. calendar.
Okay, so what did that actually do to the numbers? Well, the practical effect of this administrative change was that management pulled approximately $100 million of international sales that technically belonged in the fourth quarter of 2025.
Wow.
And they essentially shifted it into the first quarter of 2026.
But hold on, let me play devil's advocate here for a second. This is fully GAAP compliant, isn't it?
Oh, 100%.
It's a standard fiscal alignment that their auditors definitely signed off on. So if the SEC allows it and it makes the reporting cleaner to and forward, aren't we just being a little overly punitive by calling it a mask for weak growth? I mean, every multinational realigns their quarters occasionally.
It is not about the legality of the accounting. It is about the timing, the optics, and ultimately the market's trust.
Fair point.
You are absolutely right that it is GAAP compliant. But remember our framework here. This is a business priced for absolute perfection.
Right, they have a massive premium multiple.
Exactly. So when a premium company misses its internal volume targets, the market cares significantly less about the formal legitimacy of an accounting rule and significantly more about the underlying economics.
Because the underlying economics were bad.
Really bad. If you exclude that $100 million calendar-driven shift, global Q1 2026 organic operational growth wouldn't have been positive at all.
What would it have been?
It would have been down 5%.
Oh, wow.
Yeah, their international growth would have been totally flat rather than the 10% organic growth they proudly reported on the earnings call.
So they essentially used an administrative change to bridge the gap during a fundamentally weak quarter.
Precisely. Using a calendar shift to pad what is clearly a difficult operating reset, it really damages credibility.
Yeah, I imagine the buy-side guys hate that.
They do. When an analyst reads that print, the immediate thought is, if the business was actually crushing it, they wouldn't need to lean on a $100 million stub period adjustment to make the quarter look okay.
That makes total sense. And the internal operational pressure isn't even the whole story here.
Not at all.
The memo lays out three distinct, hard, external overhangs that are circling the company like sharks right now.
The legal and regulatory issues.
Exactly. First, you have the European Commission. They formally opened an antitrust investigation into Zoetis over possible anti-competitive conduct regarding a competing novel biologic medicine for canine pain.
And antitrust probes in Europe are notoriously slow. They are incredibly expensive to defend, and structurally, they're just a massive distraction for the executive team.
What's the actual allegation there?
It essentially centers on whether Zoetis tried to artificially block a pipeline competitor to protect its own monopoly in the pain space. But honestly, the European issue is actually the mildest of the three overhangs.
Right, because the second and third issues come straight from the U.S. Food and Drug Administration.
Yeah, the FDA.
The FDA issued what's called a Dear Veterinarian letter regarding Librela. And for context for anyone listening, Librela is Zoetis' absolute blockbuster drug for osteoarthritis pain in dogs.
It was supposed to be their next massive growth engine.
Exactly. And the FDA issued this letter after reviewing a spike in adverse events. And we are talking about severe reports here. Neurologic signs, urinary incontinence, and, in some extreme cases, death or euthanasia.
We really need to explain why this is so critical. Librela is not a traditional chemical drug. It's not like an NSAID, which is what dogs have historically taken for arthritis. Librela is a monoclonal antibody, or a mAb.
Okay, break that down for us. What is the biological mechanism here, and why does the FDA treat it so differently?
Sure. So a traditional NSAA reduces inflammation systemically throughout the body, but it can be really hard on a dog's liver or kidneys over time.
Right, vets always warn you about the liver enzymes.
Exactly. A monoclonal antibody is different. It's a biologically engineered protein designed to target one very specific thing. In Librela's case, it targets and neutralizes something called nerve growth factor, or NGF.
Nerve growth factor.
Right.
Okay.
And by shutting down NGF, you effectively shut down the pain signal from the arthritic joint to the brain. It is highly, highly effective at stopping pain.
So what's the problem?
The problem is that nerve growth factor isn't just involved in joint pain. It's actually involved in the survival and maintenance of sensory neurons throughout the entire body.
Uh-oh. So if you artificially suppress NGF systemically just to stop a dog from limping, you might inadvertently crosswire or degrade the nervous system somewhere else.
That is exactly the medical concern. When you introduce a novel biologic like this, the post-market surveillance is intense.
Because you don't know the long-term systemic effects yet.
Right. So when the FDA starts seeing a pattern of dogs losing control of their hind legs or experiencing severe urinary issues after receiving Librela injections, they act fast.
And they didn't just stop at the Dear Veterinarian letter, right?
No, they've been.
That is the third overhang. The FDA documented actual mandatory labeling changes for Librela to warn about these very risks. And then they issued an entirely separate untitled letter to Zoetis regarding promotional risk disclosure,
Which is a huge deal in pharma.
basically accusing them of minimizing the risks in their marketing materials.
Right.
So if I'm an investor, how do I weight this? Because pharmaceutical companies deal with FDA warnings and legal noise all the time.
Right.
It's just part of the cost of doing business in healthcare.
On their own, you're right. None of these issues completely breaks the long-term investment thesis. But together, they materially raise the burden of proof.
The compounding friction again.
Exactly. A truly exceptional bulletproof company can survive an antitrust probe. It can survive an FDA labeling change. What it struggles to survive is the combination of legal noise, a safety crisis on its most important growth driver, a macro-sensitive consumer base pulling back on spending, aggressive new generic competition, weak organic growth masked by accounting shifts, and massive balance sheet leverage.
Yeah, when you list it all out like that.
Present day is incredibly messy.
Very messy. But to understand why the market is currently pricing Zoetis as if none of this mess exists, to understand how they built this fortress valuation to begin with, we have to look backward.
We do.
And the memo goes deep into their history.
And it is vital context. Zoetis did not start in a garage.
Right.
It wasn't some scrappy biotech startup fighting for venture capital. Zoetis was spun out of Pfizer in 2013. When they went public, they did so with an embedded massive advantage.
We hear the term spin out all the time in finance. But what did they actually inherit from Pfizer on day one?
They inherited a sprawling global manufacturing footprint that honestly takes decades and billions of dollars to build from scratch. They inherited deep, multi-generational relationships with global distributors.
Stuff you just can't buy overnight.
Exactly. But most importantly, they inherited an entrenched regulatory organization. They had a massive team of people who knew exactly how to navigate the FDA, the USDA, and the European Medicines Agency, because they had the full institutional weight and lobbying power of Pfizer behind them for decades.
So if you're an analyst looking at their historical performance, how does that Pfizer DNA change the way you score them? I mean, how much credit did they get?
It creates a massive analytical distortion.
How so?
Well, the bullish narrative is that Zoetis executed flawlessly as an independent company and built this incredible moat all on their own. But the skeptical buy-side version says, wait a minute, you cannot give a management team full credit for a moat they simply inherited.
Ah, right. They started on third base.
Exactly. An entity spun out of Pfizer with that much product breadth and political capital should be expected to dominate challengers. It's the baseline. The real test of an investment isn't the assets they were handed at the starting line. It's what the public company management actually did with that embedded advantage over the last decade.
Okay, let's trace that management history then. Because what they did with those assets actually changed the entire trajectory of the company.
It really did.
Let's start with the Juan Ramon Alea era, which was from the spin-out in 2013 until 2019, The memo gives him immense credit.
Huge credit.
He recognized that a business heavily reliant on livestock selling vaccines and anti-infectives for cattle, swine, and poultry was never going to command a premium tech-like multiple on Wall Street.
Alay fundamentally understood the difference in the customer base. When you sell to a commercial poultry farmer, that farmer is running a spreadsheet.
Right, it's just a math equation for them.
Exactly. They are calculating the exact return on investment of your vaccine versus the cost of losing a certain percentage of the flock. It is a ruthless B2B margin-thin transaction. There is zero emotion involved.
But a pet owner doesn't run an ROI spreadsheet on their golden retriever.
Exactly.
Yeah.
Alike saw that the humanization of pets was this massive macro megatrend. People were starting to treat their dogs and cats literally like their children.
I mean, I definitely do.
Right. So he pivoted the immense R&D weight of the company aggressively away from livestock and into premium companion animal therapies.
The stuff people buy for their pets at the vet.
Yes. This was the era where they launched Apoquel for canine itching, Cytopoint, and really got the approvals rolling for Simparica Trio, which is the one that combined flea, tick, and heartworm protection into one single monthly chew.
So he essentially shifted the company from selling industrial agricultural supplies to selling premium consumer-adjacent healthcare.
And it was arguably the strongest strategic move in the entire history of the animal health sector.
Wow. Okay, then Kristen Peck takes over as CEO on January 1st, 2020.
Right.
And she pushes the gas pedal even further in that direction. She moves the company heavily into data, diagnostics, and those monoclonal antibodies we talked about earlier.
Giving us products like Librela for dogs and Solensia for cats.
And the financial results of this decade-long pivot were staggering. I mean, the defining statistic of the entire memo is this. In 2013, companion animal revenue was only 35% of Zoetis' business.
Right.
By 2025, it had shifted to roughly 70%. That mix shift drove massive gross margin expansion and pushed their GAAP net income to almost $2.7 billion in 2025.
It was an absolute masterclass in portfolio transformation.
But I have to stop you there, because looking at that 70% number, I see a totally different risk profile.
How so?
By pivoting 70% of their business away from farmers and toward people with dogs and cats, didn't they effectively trade the steady, predictable, industrial ballast of livestock health for the incredibly fickle wallets of retail consumers?
That is the exact double-edged sword the memo exposes.
Yep.
The very strategy that improved their profit margins also radically increased their sensitivity to a much narrower set of macroeconomic assumptions. The old Zoetis, the one heavily in livestock, was a diversified, all-weather platform.
It survived no matter what the stock market was doing.
Yes. But the new Zoetis behaves like a premium retail therapeutics business. And that is fantastic when interest rates are zero, consumers are flush with stimulus cash, and everyone is adopting because exceptional capital allocators, the kind who actually deserve a premium multiple, they earn their reputation by buying back their own stock when it is clearly misunderstood by the market and severely undervalued, or when their internal visibility into future demand is crystal clear and highly positive.
And Zoetis did the exact opposite.
They leaned into one of their largest share repurchase years ever at peak cycle valuations, right when their visibility was actually plummeting in dermatology, osteoarthritis pain, and overall pet owner discretionary spending.
So the historical mix shift was undeniably a massive success for their margins. But it fundamentally altered the company's DNA. It made them more fragile.
Much more fragile.
And then management spent billions buying stock right at the absolute peak of that fragility.
It's baffling.
This sets up the structural dynamic perfectly. The memo argues that Zoetis successfully upgraded itself into a phenomenally better business, but the very success of that upgrade radically narrowed their margin for error.
Let's unpack what narrowing the margin for error actually means in practice. To sustain the current valuation, Zoetis is highly dependent on the continued medicalization of pets.
Okay, define medicalization in this context.
It means moving a pet from receiving basic, episodic care, like getting a rabies shot once every few years and going home, to being placed on chronic, recurring, premium pharmaceutical regimens.
A subscription model for dog health.
Basically, yes. It requires the vet to convince the owner that an itchy dog shouldn't just get a cheap, over-the-counter soothing oatmeal bath, but needs a permanent, lifelong prescription for Upelkel.
Which is expensive.
Very. And it requires strict pricing discipline from Zoetis, meaning they have to be able to raise prices 3 to 5% every single year without losing any volume.
Right.
And crucially, it requires a macroeconomic environment where the pet owner doesn't blink at a $150 monthly pharmacy bill for their dog.
So the bridge from the past Zoetis to the present Zoetis is not simply they are the same quality company, just much larger. It is the same institutional brand, but it's resting on a much tougher, less forgiving, highly cyclical earnings base.
Exactly. And if the margin for error has narrowed that much, the obvious question is, what happens when they hit a macro wall at full speed?
Which they did.
Yes. To answer that, we have to look closely at the Q1 2026 disconfirming evidence in the U.S. market.
Let's do that, because the U.S. market is 55% of their total revenue. It is the absolute crown jewel of the company. And in Q1 2026, U.S. companion animal revenue fell by 11%.
An 11% drop in the core growth engine is a shock to the system.
It's huge.
And on the earnings call, management cited a whole laundry list of reasons. They mentioned lower clinic traffic, cautious pet owner spending, generic pressure on legacy drugs, and fierce competitive pressure specifically in dermatology and against Simparica Trio.
When you look at that list of reasons, the thing that stands out to me is that they're all happening simultaneously.
This is the concept of compounding friction we mentioned earlier.
Right.
In isolation, a great company can manage any one of these headwinds. I mean, if it's just competitive pressure from a new rival drug, you lean on your clinical differentiation and your massive sales force. If it's just macro pressure, you lean on your scale and offer rebates to the clinics.
Right, you pull different levers.
If it's generics, you accelerate your R&D pipeline to replace the lost revenue. But when all of these forces show up at the exact same time, each weakness amplifies the others.
Let's put ourselves in the shoes of a local veterinarian to see how this friction actually works in the real world. A vet might clinically prefer a Zoetis product, right? They know it works. They trust the brand.
Sure.
But the clinic owner tells them to buy less of it because they were worried about overhead costs and they don't want cash tied up in expensive inventory on the shelves.
Exactly.
At the same time, the pet owner might genuinely want the best drug for their dog, but they defer the treatment because their auto insurance and their grocery bills just went up 20%.
Yeah, they just can't afford it this month.
And then the regional distributor, who acts as the middleman, they might want to stock up on Zoetis products to hit a volume rebate, but they refuse to reorder because their own warehouses are backing up with unsold inventory.
That cascade of friction is a structurally harder setup than the market has priced into the stock. The bullish defense you always hear is, well, Zoetis has an impenetrable moat.
Right.
The memo acknowledges that Zoetis has deep veterinary relationships and unmatched regulatory know-how, but a moat is not a magical force field, it is conditional.
Let me throw an analogy at this idea of the healthcare moat, because people in finance often talk about healthcare moats like they're software moats, like it's an enterprise SaaS company or something.
Oh, this is a great comparison.
Right, because if you're a massive corporation and you want to switch from Microsoft to Google, the switching costs are agonizing. You have to migrate databases, you have to retrain thousands of staff, you risk operational downtime, you are completely locked in.
But a veterinary clinic is not an enterprise software client.
Exactly. If a vet decides to prescribe a competitor's new, maybe slightly cheaper skin cream, instead of Zoetis' Upelkel for a brand new puppy that just walked into the clinic, there is no unsubscribing hassle. There is no database to migrate. The switching cost simply does not exist for the new patient.
That distinction is so crucial.
The historical moat protects the old, habituated patients who are already on the drug, but it doesn't protect the new patient funnel at all.
It really doesn't. Healthcare switching costs at the clinic level are just a mix of clinical familiarity, protocol convenience, and owner compliance. If a competitor like Boehringer Ingelheim or Elanco runs a massive promotion, or if they offer a slightly more convenient dosing schedule, the vet can simply write a different script for the next patient.
It takes 5 seconds to write a different name on the pad.
Literally 5 seconds. And the memo notes that Zoetis management directly admitted that in Q1 2026, competitive pressure resulted in lost volume. The moat did not hold the line against new competitors offering better economics to the clinic.
Which makes management's bold claims about their total addressable market, or TAM, feel totally disconnected from the ground reality.
Oh, the TAM claims.
Right. In the recent innovation webcast, management claimed the TAM for animal health will grow from roughly $50 billion today to somewhere between $85 and $95 billion by 2035. They're throwing out massive projections. They're talking about a $3 to $4 billion market for chronic kidney disease in pets, and up to $1.7 billion for pet oncology.
We have to apply our skeptical buy-side lens to those TAM claims and explain how TAMs are actually used in financial modeling. TAM figures are directional maps. They are not valuation-grade forecasts.
Okay, break that down for us. How does an analyst use a TAM, and how does management maybe abuse it?
Well, when management says the oncology TAM is $1.7 billion, they are making a massive set of assumptions. They are assuming a certain percentage of dogs will get cancer, a certain percentage of owners will actually choose to treat it rather than euthanize, and that they will pay a specific premium price for that treatment.
Which is a lot of leaps of faith.
Exactly. Then an analyst takes that $1.7 billion, drops it into an Excel spreadsheet, assumes Zoetis captures, say, 40% of it, slaps a 30% profit margin on it, and discounts it back to the present day to justify a higher stock price.
It's a house of cards built on hypothetical math.
Precisely. The fact that the market for pet oncology might be $1.7 billion in a decade tells me absolutely nothing about how much of that market Zoetis will actually capture.
Right. At what profit margin and against what competition?
The real question isn't the size of the ocean. It's how many fish you can actually get into your boat without the boat sinking from the cost of the nets.
I love that. So declining revenues and theoretical future TAMs are one thing. But if this compounding friction is causing vets and pet owners to pull back, that bleed has to show up somewhere in the financials.
Oh, it does.
And the first place it shows up isn't just top-line revenue, it's margins. We need to look at the financials and capital allocation section of the memo.
Let's start by giving credit where it's due, just to establish a baseline. The historical financial strength of Zoetis is remarkable.
Unquestionably.
If you look at management's data from 2020 to 2024, they show an average post-tax return on invested capital, or ROIC, including goodwill, of 26 to 27%.
Okay, let's define ROIC for you listening, because it's the holy grail metric for compounders.
Right. So return on invested capital essentially measures how efficiently a company turns capital, meaning both debt and equity, into profitable growth. If you give a company $1, how many cents of cash profit do they generate with it?
And 26% is incredible.
A 26% ROIC is an elite number. It means their historical core business was an absolute cash printing machine. It is significantly better than simply looking at return on equity, which can be artificially boosted by taking on massive amounts of debt. And by including goodwill in the calculation, it also holds management accountable for the premiums they paid for past acquisitions.
So the history is elite. But then we hit the Q1 2026 reality check, and we see what the memo calls decremental margins. U.S. revenue declined by 8% overall, but U.S. earnings declined by 11%. And their U.S. gross margins slipped from 83.2% down to 82.2%.
This is a masterclass in the danger of high-margin businesses.
How so?
When you have a product portfolio carrying an 83% gross margin, it means the variable cost to produce the actual physical drug is incredibly low.
It costs pennies to make the pill.
Exactly. But the fixed costs, the massive manufacturing plants, the R&D labs, the global sales force, those remain incredibly high.
So when top-line growth decelerates even slightly, it creates a disproportionately painful drop in earnings.
Yes. The profit pool shrinks much faster than the revenue line because those fixed costs don't go away, and the lost sales were your absolute highest margin incremental dollars. It's a harsh reminder that even the best unit economics in the world are not bulletproof when the premium categories driving them start to stall out.
And as those margins were stalling, what was management doing with the balance sheet? We touched on the $3.2 billion share repurchase earlier, but we really need to unpack the exact mechanism of this 2025 financial engineering.
Yeah, because the memo is brutal on this point.
They didn't just use free cash flow from their operations to buy back that stock. They issued massive amounts of debt.
The expansion of the debt stack is glaring. In 2025 alone, Zoetis issued $850 million of senior notes due in 2028. $1 billion of notes due in 2035, and a massive $2.0 billion of 0.25% convertible senior notes due in 2029.
Wait, 0.25%?
Yeah. Total debt ballooned from $6.65 billion at the end of 2024 to $9.15 billion by the end of 2025, and it stayed elevated right through Q1 2026.
Let's break down that $2.0 billion convertible note for a second, because 0.25% interest is basically free money.
It is.
How does a company secure a rate that's incredibly low in a normal interest rate environment? And what does convertible actually mean for the investor holding the bag if the stock drops?
Right. So a standard corporate bond might require paying 5 or 6% interest. To get a rate of 0.25%, the company has to offer the bond buyers a sweetener.
A bribe, basically.
Essentially, yes. That sweetener is the convertible feature. It means that if Zoetis' stock price rises above a certain predetermined strike price, the bondholders can actually convert their debt into shares of Zoetis stock.
Oh, wow. So they're trading interest for dilution. The bond buyers are accepting almost zero interest in exchange for a call option on the stock.
Exactly. But the catch is dilution. If the stock goes up, those bonds convert into millions of new shares, which dilutes existing shareholders.
Right.
But if the stock goes down, Zoetis still owes the $2 billion in principal when the note matures in 2029.
So they increased their debt by $2.5 billion in a single year, locking in future obligations or dilution, largely to fund $3.2 billion in share buybacks, right as their U.S. companion animal business was about to drop 11%. It's like taking out a second mortgage on your house to buy incredibly expensive art for your living room, just so the appraiser increases the home's stated value and you get a bonus from the bank. The house looks richer on paper, but structurally, you're carrying a much heavier, much more dangerous burden.
That financial treadmill metaphor perfectly captures the dynamic. The bullish Wall Street analysts will tell you that securing a 0.25% convertible note is brilliant, cheap financing.
Sure, sounds smart.
And they'll say buying back stock reduces the overall share count, which artificially pads earnings per share. But a skeptical investor looks at the timing. Zoetis loaded up on debt to buy stock at the absolute peak of the market right before their operational visibility vanished.
This looks terrible.
It severely weakens the claim that they are disciplined, elite capital allocators. It looks defensive. It looks like they were trying to mechanically prop up the stock price as the organic growth engine started to sputter.
Which leads directly into a question of motivation, right? Why would management do this?
Incentives.
Exactly. You have to look at how they are compensated. Executive incentive structures always tell you what the company actually values. Zoetis executives are compensated based on three main metrics: adjusted diluted EPS, revenue growth, and relative leverage. Total shareholder return, or TSR.
You have to follow the mathematical loop there. If your annual bonus is heavily tied to earnings per share and total shareholder return, and you issue $2 billion in cheap convertible debt to buy back 23.9 million shares.
Your share count drops.
Right, and because the share count drops, your earnings per share goes up, even if the actual net income of the business is totally flat.
Wait, so if I'm the CEO, I'm literally incentivized to take on debt to buy stock just to boost my EPS?
Yes. And because you are buying billions of dollars of stock in the open market, the stock price is artificially supported, which boosts your total shareholder return.
The compensation structure fundamentally rewards this behavior. It does not penalize debt-funded buybacks at all, even if it degrades the balance sheet right before a major operating reset. Management gets paid for the financial engineering, and the long-term shareholder carries the risk of the debt.
And the optics games don't stop at the buybacks.
Of course they don't.
The memo points out management's heavy reliance on adjusted figures. When they report earnings, they don't just give you the GAAP numbers, they give you adjusted net income.
Oh, I hate adjusted numbers.
They're the worst. In Q1 2026 alone, they added back $45 million in what they called restructuring charges and business process transformation costs.
Every company claims restructuring is a one-time expense. But if you are restructuring every single year, it's just a regular operating expense that you are hiding below the line.
It is standard healthcare industry practice, unfortunately. But it means the picture management paints of their own performance is always the absolute cleanest, rosiest, most optimistic version possible.
So as Zoetis is playing these games with their balance sheet and their adjustments, how do we benchmark them? I mean, how do we know if they actually deserve a premium valuation?
We look at the peers.
Right. The memo does a brilliant job comparing Zoetis to its peers to reframe the entire investment question. It starts by saying, look, yes, Zoetis is vastly superior to a competitor like Elanco.
Well, beating Elanco is basically a participation trophy in this sector.
That's rough.
It's true. Elanco is heavily leveraged. They lost $232 million in 2025. They have $3.7 billion in debt and barely any cash on hand. If you compare Zoetis to Elanco, Zoetis looks like a godsend.
But if you want to know if Zoetis deserves a true premium multiple, you have to compare them to a true premium peer. And the memo points directly to IDXX Laboratories.
IDXX is the gold standard comparison.
They don't make pharmaceuticals, right?
No, they make veterinary diagnostics.
Yeah.
The blood analyzers, the software, the testing equipment inside the clinic itself.
Explain why that business model is so powerful. Because the memo loves IDXX.
IDXX operates on a classic razor and razor blade model. They sell the blood analyzer machine to the vet clinic, that's the razor, and then the clinic has to buy the proprietary testing cartridges, the razor blades, every single day for years.
And they can only use IDXX cartridges in the IDEX machine.
Exactly. Once a vet installs an IDEXX machine and trains their staff on the IDEX software, the switching costs are astronomically high.
Ah, so there is the software-like moat we were looking for earlier.
Exactly. And the financial contrast between Zoetis and IDEXX right now is sharp. In 2025, while Zoetis was showing all these cracks, IDEXX grew its revenue at 10.4%. They have incredibly clean, transparent companion animal economics, and most importantly, their leverage is practically non-existent.
No debt-funded buybacks.
Nope. IDEXX has a net debt to adjusted EBITDA ratio of just 0.43x.
Wow. So IDEXX is growing faster, has higher switching costs, and is carrying almost no debt.
This comparison is devastating to the Zoetis bull case. If you are an institutional portfolio manager with capital to allocate to the animal health sector, and your mandate requires you to buy a pristine, high-quality compounding asset, why would you buy Zoetis?
You wouldn't.
Zoetis is highly leveraged, relying on adjusted add-backs, facing an antitrust probe in Europe, dealing with FDA safety warnings on its flagship pain drug, and suffering an 11% drop in its core U.S. market. You wouldn't buy it. You would buy IDEXX instead. Zoetis is still a very good business, but it is incredibly hard to argue mathematically that it is the best place for incremental investment capital right now.
Okay, so we have dragged the history, the biology, the compounding friction, the moat, the financial engineering, and the peer comparisons completely out into the light.
We covered a lot.
How do we synthesize all of this deeply complex information into an actionable investment decision? Let's move to the final summary and scenario analysis.
The first, most crucial step is acknowledging that the baseline assumption for this stock has permanently shifted.
The old narrative is dead.
It has to be. For a decade, the historical base case for Zoetis, the one Wall Street analysts built all their models around, was incredibly benign. It assumed broad, unstoppable macroeconomic growth, endless premiumization of the pet space, perfect management execution, and steady, uncontested pipeline innovation.
But the memo argues that reality has intruded.
Big time.
Today, the true base case must include persistent, aggressive generic competition and lingering, stubborn macro softness. It is a completely different paradigm. To map this out, the memo lays out 3 specific scenarios for the future: the bull, the base, and the bear.
Let's walk through the mechanics of each. First, the bull case. What has to go right?
Everything.
Pretty much. In this scenario, U.S. companion animal demand miraculously stabilizes by the second half of 2026. The distributor inventory backups clear out and reordering normalizes. Zoetis successfully uses targeted promotions and rebates to protect their market share in dermatology against competitors without permanently destroying their own pricing power.
Okay, what about Librela?
The osteoarthritis pain drugs, Librela and Silencia, they shake off the safety concerns and return to rapid growth. And finally, the FDA and European Commission issues are resolved with minor fines and remain completely contained.
So, under that bull case, the stock probably works. The business resumes mid-single-digit growth. But it requires almost flawless execution across every single division from here on out. And it requires the market to be willing to maintain that massive premium multiple.
Now consider the base case, which is the most statistically probable outcome. Competition in dermatology and parasiticides from companies like Boehringer Ingelheim and Elanco persists, and it takes a few points of market share.
Which hurts the top line.
Right. Macro price sensitivity from pet owners lingers, preventing Zoetis from raising prices as aggressively as they used to. The OA pain franchise continues to grow, but only very gradually due to the lingering FDA safety overhang making vets cautious.
And the R&D pipeline.
The R&D pipeline delivers, but it's mostly incremental life cycle updates, like turning a monthly pill into a quarterly pill, not revolutionary new blockbusters.
So in that base case scenario, you get low to mid single-digit revenue growth. You get modest margin slippage because they lose a bit of pricing power. It's still a massively profitable company generating cash, but the returns for an investor buying the stock today are totally mediocre.
Totally mediocre.
Why? because the stock is currently priced as if it is an elite high-growth compounder. The valuation multiple would have to compress downwards to reflect the reality of a good business rather than a flawless one.
And finally, we have to look at the bear case. In this scenario, the new competitive launches from rivals are highly disruptive and shatter the dermatology monopoly.
Oh boy.
Pet owner affordability breaks down further as the economy weakens. The Librela safety and legal noise from the FDA in Europe deepens into a true crisis, resulting in severe restrictions on how the drug can even be prescribed.
That would be devastating.
And the R&D pipeline suffers a major clinical trial failure. And worst of all, the massive debt-funded buybacks they executed in 2025 become an albatross around their neck, because the core earnings drop is too severe to service the debt comfortably without cutting investment elsewhere.
The outcome in that bear case is flat to low single-digit growth. The premium categories entirely lose their pricing power. The valuation multiple violently compresses, and the total return severely disappoints anyone holding the stock today.
When you weigh the probabilities of those three scenarios against the current price of the stock, the verdict becomes very clear. The closing judgment of the buy-side memo is this. Zoetis is a great historical company. It is a good current business, but it is a hard pass as an investment today under a high-bar framework.
It simply relies on way too many optimistic assumptions that no longer deserve default confidence. As an investor, you can't default to trusting the old 2021 narrative when the new 2026 data clearly shows U.S. companion revenue dropping 11% and management masking flat international growth with a fiscal calendar shift.
Precisely. To be an aggressive buyer of Zoetis today, you have to assume that the macro environment heals itself, the FDA backs off completely, competitors suddenly forget how to innovate, and management's peak cycle debt-funded buybacks were actually a stroke of contrarian genius rather than a defensive, optic-driven misstep.
That is far too high a wire act for disciplined capital.
It really is.
But a good, rigorous buy-side memo never just says no and walks away. It always tells you exactly what would change its mind.
Right, the catalysts.
So what are the three specific conditions that would have to be met for this thesis to shift from a pass to a buy?
Condition number 1. We need to see clean, non-calendar-aided reacceleration in the U.S. companion animal segment.
No accounting tricks?
Exactly. No shifted quarters, no adjusted add-backs, just real, verifiable, organic volume growth, especially in the highly contested dermatology and parasiticide markets. Management has to prove that the moat can hold the line against competition in a tough economy.
Makes sense. Condition number 2, I'm guessing, is about the pain drugs.
Yes. The osteoarthritis pain franchise, specifically Librela and Silencia, needs to demonstrate sustainable, reaccelerating growth without any new regulatory or safety escalation from the FDA or the European authorities. The controversy has to be definitively bounded and put in the rearview mirror.
And condition number 3.
The valuation multiple must mathematically reset. The stock price has to drop to reflect the reality that Zoetis is currently in a prove-it phase, not a flawless compounding phase. If the market sells it off deeply enough to price in the current risks and the debt load, it becomes a highly interesting turnaround play.
But not a penny before.
Not a penny before.
Okay, let's bring this entire analysis home. For everyone listening, whether you are managing a portfolio or just trying to understand the business of veterinary medicine, here is what you need to remember from this deep dive. First, the incredible historical management pivot away from livestock and toward companion animals was a double-edged sword.
It built their massive profit margins.
Right, but it fundamentally traded industrial resilience for retail fragility, exposing the entire company to consumer wallet strain.
Second, the compounding friction we saw in Q1 2026 is structurally real. When macroeconomic softness, generic drug erosion, and fierce targeted competition hit a company simultaneously, even a world-class historical moat will bleed market share.
Third, management's decision to issue billions of dollars in convertible debt to fund $3.2 billion in stock buybacks at peak valuations in 2025, right before a massive operating reset that severely weakens their claim to elite capital allocation discipline.
It looks like financial engineering designed to protect executive compensation metrics rather than long-term balance sheet health.
And finally, Zoetis has decisively shifted from being an unambiguously great buy and hold forever investment into a prove-it stock that is currently failing its burden of proof against cleaner peers like IDEXX.
It's a tough reality to accept for a stock that's been a darling for so long.
Which brings me to a final provocative thought from the very end of the memo, buried in the open questions section. The memo points out that the long-term upside for this stock, the real justification for buying it today, heavily relies on management's own internal estimates for massive future cash total addressable markets in categories like renal care and pet oncology.
It is the classic Wall Street promise of a golden horizon.
Exactly. So I want you to mull this over. In an era of absolute financial information overload, how much of your conviction in a so-called premium compounder is based on hard, external, verifiable data today? And how much of it is just trusting a management team's internal PowerPoint slides about how incredibly profitable the year 2035 is going to be?
Understanding the difference between analyzing present data and hoping for future projections is the absolute core of disciplined investing.
It's like borrowing money to buy a house based on what the neighborhood might look like in 10 years, while entirely ignoring the termite damage in the foundation today. Thank you for joining us on this deep dive. Keep questioning the narrative, keep demanding the hard data behind the marketing, and we will catch you next time.